Let's go.
Welcome to the Micromobility podcast / show, Erdem. It's lovely to have you here. For folks who don't know me, obviously I'm Oliver, the host of the show, but I'm very excited today because we've had, I've been following Donkey Republic for a while. Hadn't heard of you until I got to Europe and to Berlin, but you were very cheeky in the way that you took to the Micromobility conference going on, and you decided to park a bunch of the Donkey Republic bikes outside. I thought that was very, really smart.
At least you can do if you operate in Berlin, right?
Yes, indeed. So, hey, but look, it's a total pleasure to have you here, and thank you very much for making the time. What would be really great is for you to just take me through, like, what's the backstory of yourself, and then and Donkey Republic, and then I'm very curious, like, where did the name come from, and things like that. But yeah.
Sure, Oliver. Nice to meet you. Thanks for having me. So my name is Erdem. It's a Turkish name. I grew up in Istanbul, Turkey. For those who haven't visited, it's a very congested city. I think in top 10 in the rankings of most congested cities. And I really enjoyed when I landed in Copenhagen 13 years ago, what bikes can do for quality of life. I also have experiences of living in the US, both in Bay Area and in the East Coast, in DC and New York, and in London. And I have to say that the quality of life in Copenhagen, in my mind, owes a lot to the 40+% modality of bikes. For those who haven't lived here or somewhere in Holland or haven't visited, it really feels like a different planet. Where getting around is easy, it feels safe, it's fresh, and there's a lot of dedicated bike lanes, and most people are all the time on their bikes. I actually have some bike congestion. You might sometimes not hit the green light because there's so much queue in front of you.
Oh, no way.
Bikes. Yeah, it happens rarely, but nevertheless, there's a rush hour traffic on the bikes, and it's all very fun. You kind of socialize with people around you. So the name Donkey Republic comes from the ambition to scale bike shares that I saw back in 2013 were not scaling as they, in my mind, should, because they were bringing so much benefit. But at the same time, I was teaching entrepreneurship at the university here. And I asked the class, what is your favorite startup and CEO, and someone mentioned Uber and Travis, and I had not heard about Uber at that point. So I looked into it, and I saw the motto is everyone's private taxi cab, and I thought, wow, what a terrible vision. I thought this couldn't be. I mean, in Istanbul, a lot of people use taxis, and so do people in both East West Coast. So I thought, it could just add more congestion. And I think recent studies have shown, which I think both Uber and Lyft have also agreed to, that they are adding to congestion. So
it's a little known fact. We really didn't want to. We thought when we were with it, I used to be at Uber, so we thought we were contributing to making the place a lot better, but because you don't need to own a car, and so in theory you can reduce the number of trips on the road, but it'll, the way, obviously, lots of deadheading and all that sort of stuff. So
yeah, what are you replacing? Are you replacing public transport trips and so on and so forth? But the idea was to create a name or a system or platform that would be for everyone, not for the exclusive few. And I think Uber resonates with something more at the sort of German word. Uber is the higher level, and donkey is I wanted something back to simplicity, so an animal name, and then something I was thinking about Iron Horse, and a friend with better humor than I have said, why don't you think about donkey? That's the more funny.
Well, it's good you didn't call it ass,
Yes, that's true. Yeah. So that's the thing. And Republic is because I was aware of the critical mass, which is a bit of a movement in Europe every month, and I believe maybe potentially other cities around the globe. Cycle fans are meeting up, and I think arranged with the city traffic forces, they kind of blockade a main road, and they kind of celebrate cycling by going slow and having balloons and just having a little festival. So I really like that movement around cycling, and we wanted to create that a movement in our name as well. So that's the Republic.
Fantastic. Oh, awesome. And so, as you say, you started doing this in 2013? Is that
2013 is when I started working on the idea. 2015 is when me and the 3 co-founders, fantastic guys. Without them, I think nothing would have happened. But we went full time working on this.
Awesome. And so I know you've got a couple of slides that you'd love to pull up and we can share as well. So maybe if we just pull up because I'd love to kind of get a snapshot of where the company's at the moment. So for folks who just listening to this on audio, Donkey Republic's 13,000 bikes as of Q1 in 2021, 75 locations, 500,000 riders since 2019, Danish krona of 33 million in revenue in 2019. That obviously dipped during COVID. And we can get to the 6-to-1 for krona, right? 6 krona to a US dollar?
Yes, that's correct.
Yeah, excellent. 8.6 million trips taken since 2016, and at the moment 63 employees. And as I understand it, you're still updating these, or this was a little while back. So
a couple months old, yes. And riders, we count them as people who actually took a ride on the donkey, almost 600,000 back in March or April. And yeah, I think if you look at just downloads or registrations, we are past 1 million. But and 33 million krona in 19, that's a bit above $5 million in 2019.
Excellent. And the reason that the reason I wanted to bring you onto the podcast, and I think you're a really interesting business, is because one, you're public as a so publicly traded company. So I'd love to sort of jam on that, and we're going to dig into that today. But the second is that you have this really interesting operating model of being both an operator, but also selling a solution to cities. Right. So do you want to talk through how that works and your unique approach there?
Sure. Yes. So we have built this turnkey solution, which we operate ourselves in many cities. We kind of had to prove that this turnkey solution does work well by having it scaled in a number of cities. In this map to the left, you can see the bright orange dots are the cities that we operate, and the brown ones partners operate, and the size of the dot shows where we are, how large the operation is. And you can see we are rather strong in Denmark and Benelux, so the Netherlands and Belgium, and then a few other interesting capitals like Berlin, Barcelona, Budapest, Geneva. And those are the cities that we operate ourselves in with larger fleets. And then, or countries. So we're in Copenhagen or top 5 cities in Denmark, and also top cities in Holland. That's what we call the MaaS Mobility as a Service, where we own and operate the bikes. And we have both regular pedal bikes and e-bikes there. And we started with that model, and we had to kind of convince ourselves and then the partners that our model was working well. And we started in 2015 when micromobility was not a word that was coined yet. The first scooter companies really came to market in 2018. So this was a time when, in 2016, when we got our first venture money in, we had to convince them that there was $1 billion market for micromobility, for bike sharing, not $1 trillion market, but $1 billion.
Yeah. Oh, amazing.
It was like, will anyone really use, so this was really back in time where no one was looking into micromobility for a business that could attract venture capital. We were really pioneer, but venture capital in Europe, especially in Northern Europe, is also quite conservative. So breaking through that and sort of bringing in the kind of money that other companies have in China or US has been rather difficult or slow.
And just so I know you're going to get into, you get into SaaS cities and then the SaaS business, and then I want to come back to that part of it as well.
So in 2018, we started to see demand from a number of potential partners where they wanted to launch donkeys in their own town, and we had developed our system to make that rather easy. We have besides the bikes, we have a operator app where the shepherds, as we call them, the mechanics, can see which bikes need service, where to rebalance them. And also we have the invoicing in the admin portal that enables someone to relatively easily set up an operation and run the service. So we started doing that in a few cities, and then typically it's a partner who has some kind of it could be an NGO, it could be a utility provider, it could be a car related business, it could be entrepreneurs launching things off, and they typically have some kind of business model that brings them some cash in addition to B2C, in addition to the consumer. So it's either the city, or they are serving a university campus, or it's a utility company that wants to combine it with their buses or train network, or a car company or auto part company that wants to offer it to their parking lots, or real estate developers, and so on and so forth. Of course, many of them are backed by cities.
Awesome. And so you've got at the moment 2,700 bikes. Correct. On that, with 40 partners, 60 locations. Right. And so, and is that when I guess the part that I have is that when you do a partnership with a city, are they looking to build? Is it? I mean, I assume there's like, and maybe we can go through your slide of your existing, or like where the things are going to be growing fastest. But the sense that I get is that a lot of cities have been looking around at a lot of these scooter operators and, going, look, this is all fine and good, but actually we want to be able to build and maintain and own our own system within a city. We can sort out the parking, we can sort out make it so that it works with the infrastructure and that sort of stuff. That to me is how I kind of see a lot of governments going and responding to this.
So I'm serving as the chairman in Cycling Industries Europe bike sharing group, and I'm rather close to the discussions with the cities, both as the industry and as down to your public. And if I may, I want to start at this slide. Bike shares have been accepted since 2002 or beginning of 2000s as part of public transport in Europe. And even in the US, because you have a bunch of bike sharing systems that are publicly financed with long-term contracts. And it's quite comparable to bus and train operations, which are typically 30 to 70% subsidized or publicly financed. Right. This is a very strong or reliable recurring business model. And the reason that bikes receive this is that the benefits of bike sharing or bikes in general, in terms of congestion, CO2 savings, and most importantly, health benefits, keeping people active, is very important for public authorities. So they also serve as last mile for both train and bus. So if you want to strengthen those existing public transport, you kind of need to supplement it with sort of bike share. So for that reason, bike shares typically have been publicly financed. There was a period when Asian bike shares, the Ofo and Mobike, were coming to Europe. There was a period where cities were kind of more on the defense. So there's sort of these three periods, as I can see. So from early 2000 to 2016, cities have been procuring these bespoke, expensive bike sharing systems, typically tier 1 cities, so the largest cities. And then there has been a 3-year period where there's been an explosion of these venture-based bike and scooter sharing companies. And cities have been, going from paying a lot for this public service, having to kind of hit the brakes for something they otherwise thought was really beneficial. And then they had to understand the nuances between the different kinds of services and the different business models. They saw bike sharing fleets coming in and out, like Ofo and Mobike. They've seen also, in a bunch of cities, enter and leave the market. And to some extent, some of the scooter companies coming in and out. So one of the reasons I believe the scooters are not getting public finance at all so far. So they are receiving permits in a number of cities, and they are not receiving permits in other cities. And they have, as far as I see, they have not been publicly financed so far. They're not considered a mode of public transport, just like car share. Car share has not been publicly financed so far. So there is some from public opinion, there's some difference between bike sharing and scooter share or car share categorically in that sense.
And so when you're offering these, just so I'm really clear, so when you're offering these as kind of mobility as a service, so you've got your own service that you offer, and those are all dockless. You don't offer docked systems. They are comparable. Are they e-bikes or are they standard bikes? And like, what's the mix of that? How do you think about that aspect of the service?
Yeah, we are not recommending docks. We recommend that cities use existing public infrastructure for shared bikes, as well as private bikes. Mm-hmm. And some cities want docks. Then we are able to provide them with docks that work with our bikes. But we don't do free float, which is you can park your vehicle, your bike anywhere. We mark a bunch of what we call hubs or virtual stations on the app, where we select bike racks, the public bike racks, and then ask users to return it there. We've been using this for 5 years now with success. Cities enjoy it a lot. And a number of experts of bike sharing, actually, I heard from Russell, who's created the World Bike Sharing Map and has seen everything, who unfortunately passed away last year, but was also saying, this is the future. It really makes sense that you don't have to create a parallel infrastructure to the private parking, that you have to create yet another parking infrastructure for the shared vehicles.
Absolutely.
There are other components in this wheel down here. You can see controlled parking, affordability for the actual customers. Cities would like to work with local partners. They want to see bikes that actually last. How do you operate them in a sustainable way or not? Do you use gig economy when you service your bikes, or do you employ people? And so these are some of the elements they look at when they are picking who they should permit, or actually who they provide public finance for.
And so the majority of those, the city deals that you're winning, are these, are they actually like subsidizing those bikes in most of those places? Yeah, okay, right. So like fully integrated into other apps, so you can have, you can hop off and in theory have that be work with a transit card, or is it still bookable in an app, or is there any level of integration there?
Interesting you bring this up. I believe we are also on the forefront of that. We offer the TOMP integration, which is a open bike group from Netherlands, which was sponsored by the Ministry of Transport of Netherlands, which is a very cycling country. They wanted to make sure that bike sharing is integrated to public transport from the get-go. So they set up a budget. They created 7 pilots in 7 regions in Holland, and these regions, the MaaS aggregators and the operators such as ourselves, many others together in a group of about 20 aggregators and operators, have come up with both the technical and the commercial conditions of aggregating or full integration of bikes. And now it's actually expanding to other vehicles, which is shortly called TOMP. And
interesting. So is this like a competitor to the GBFS standard?
As well as I know, GBFS is more about data reporting to cities and not for full integration, where you can book and rent a bike. And where the aggregator is responsible for all the different aspects of what happens to the bike, and charging the customer and billing them and so on and so forth. So GBFS is still used, I think, as the dominant standard for reporting data to cities, whereas TOMP API seems to be picking up as the full integration of micromobility to those integrators. And that is so because of exactly what you mentioned. Initially, cities are requesting that Donkey and other services they procure are able to fully integrate to their publicly qualified MaaS aggregation apps.
Totally. And it's actually really interesting. This is the first I've heard of TOMP. And I follow, it's one of these weird little rabbit holes that one ends up with when ends up going down when one's interested in micromobility. But I've actually interviewed the team from the developed GBFS, and the mobility data spec, MDS, which is the other one that's oftentimes used for data reporting, and it's very common in the US. But this is very interesting. So has Tomp been adopted by other players in Europe as well? It's not.
Yes, many of them.
And other cities as well, not just the Netherlands.
Yeah, not just the country of Netherlands, but many other countries or cities in other countries are using Tomp, because there has not been a standard, and everyone is saying that we do need a standard. So it looks like the most promising standard. I don't think there are yet many services up and running. We might be the first one. So we just integrated or fully integrated to a couple of aggregators in Holland as of last month.
Excellent. Okay, great. I'm going to go dig into this. Yeah, it's marvelous. Excellent. Well, look, the other thing as well that I'm kind of curious about is that you've obviously built a business where you've got your operators. You've got your own operations, and then you're bidding in these cities. And then you've got other cities that are sort of saying, look, we want to effectively pay for and run our own services. We just need someone who can like actually operate it, but we'll pay for it and everything. What is the breakdown of cities like? Is it typically like larger cities feel like they can get by with having the private sector solve for this, or, and therefore they kind of are looking for smaller cities to make that, the smaller cities are the ones who say we'll pay for it because we don't feel that we can get that out of the private sector, or how does that break down?
I see. I don't have my market slide here, but I'll cap it quickly. Also good for the audio. As we see it, there are about 3 tiers. The 1+ million population cities. There's about 20 of them in Europe. They are the tier 1 cities that everyone wants to play in. They have the highest density of population, where micromobility makes most sense. And they are already having 90+% of them have a micromobility or a bike share service that they official bike share service that they pay for. And they have the highest density of bike sharing, about 3 bikes per 1,000 citizens or residents.
Right.
And then you have the tier 2 cities, as we classify it, is between 200,000 and 1 million people, and then tier 3 between 20,000 and 200,000. And in those 2 groups, you have about 2,500 cities in Europe. Especially in the tier 3 group, you have 2,000 cities. So that's really or 2,200 cities. So that's really the large group, and then the medium group is about 200 cities.
Yep.
So a number of tier 3 cities, most of the tier 3 cities don't yet have a micromobility service that they officially sponsor. And without public finance, most of them do not make sense unless there's a lot of visitors or university campus. It won't make sense financially to set up an operation there without public finance. So the cities there are typically right now post-COVID, and I'll touch on that. EU is really pushing this agenda, and so are many countries, so national governments. So many cities, also tier 3 cities and tier 2 cities, who historically have not put as much money and attention into bike sharing, are actually gearing up and pushing this agenda forward. And when they do procure a bike share, unlike tier 1 cities, they're not so much into branding themselves as, we have our own brand or our own app. They want something they know that works, and they care about the affordability. They want something responsible. And so Donkey fits really well because we are very affordable, both for the city and for the rider. We don't do white label, which might disqualify us from other cities that do want that. But then we can deploy very fast, and we have a lot of flexibility in the product. We can work with local partners, which smaller cities quite like. And we can set up the price scheme, or we can create the hub map as they like. And also we can create exclusive bikes or discounted memberships for certain groups that, let's say, public workers. And so we can do a lot of things that they would like to see.
Fantastic. And with that, I can totally see that well, I can totally see that that's the case where you've got those smaller cities where the standard economics probably wouldn't stack up. Is there funding? Does that funding typically come from local councils, or are there national level governments that are effectively saying we're going to fund that? Or does it change city by city, or is there some sort of like standard funding system across the EU around how those would end up funded?
Okay, so I think local and regional governments are behind the funding, and typically local governments need to apply for funding of such thing in their budgets. Oftentimes, the national government has a program that they apply to, unless they place some of their unearmarked money into building, procuring some bike sharing.
Right.
Post-COVID, EU has set up a 700 billion euro recovery budget. And this 700 billion budget, 1/3 of that has to be spent on sustainable development, or also green development, you could say. And because one of the vice presidents of EU is actually from Holland and a big advocate of cycling, and the DG Move, so Director General of Transportation in Europe, is also very publicly pro-cycling. They have also managed politically to put into the program of post-COVID reconstruction that the mobility services and smart services where you can get services on the go, and cycling infrastructure specifically, are recognized as part of these sustainable developments. So a bike sharing is triggering both, or tick marking both of those conditions.
Yes.
Because it's a smart service and it is improving the infrastructure for cycling. So we see a lot of cities now are piggybacking on that budget, and they have to use that within the next 2-3 years. So there's a lot of demand right now.
Yeah. Oh, that's very, I mean, exciting for you as an operator, obviously. Well, look, I want to kind of shift gears a little bit around around that, because I mean, I think that's obviously very exciting around the fact that it's very exciting to see that there's obviously a lot of development on that side, and that the governments are finally getting their acts together. Because I think this has been one of those things that, like, certainly in the early days of the kind of shared micromobility explosion, it was very obvious it felt very obvious to me, having been at Uber and seen how the regulatory response was to that there was no way that, you've got all your stuff on the street, like this idea that you're going to be able to continue to operate and that everybody will be very happy with you just wasn't. And that's what we saw, literally, like people would go out at night and take up all your scooters, and all of a sudden you got $1 million worth of inventory that's just stuck in behind a locked key door somewhere, and nobody would get it back. So it's obvious that there's going to need to be a lot more interaction and a lot more regulatory framing, but very exciting to see, because I think in some ways Europe leads the world on how these shared systems are going to get built. Certainly there's a lot more funding available than a lot of other places. It is interesting to me how quickly it happens. And obviously COVID I think has really accelerated that. Obviously a bit of a bad year for you last year, but I assume that's, a lot of this comes down to good quality infrastructure, that there's road space allocated to people so that they feel safe to be able to go and ride in these places, etc. Any commentary in there?
No, I think I agree with all you say. One of the things, I guess, is there's a lot more skepticism about technology companies bring positive welfare by definition. We tend to advocate for things like, Uber or Lyft would reduce congestion. That was sort of the rhetoric for a long time. And then studies were made and it was proven or shown that it wasn't the case. And similar resentments about Facebook and Google and Airbnb and Amazon and so on and so forth. There is a resentment about large VC-backed, we're going to conquer the world next year or in 3 years' time kind of rhetoric is not from the get-go is not what resonates with public officials. But that is exactly what resonates with the investors, with the venture capital investors. So you have this dichotomy, like one force pulls one direction, the other to another direction. And I'm happy to say that at Donkey, we have bet on positive regulation. We have bet on regulation coming into place. We've created the virtual hub-centric operation, which was not the preference of the riders. the citizens preferred it. They didn't want the vehicles all over the place, but the riders thought, oh, why can't I park the bike 50 meters right at my doorstep? Well, you know what? Because it's annoying for the next guy. And it's in the long term, it's not going to be viable. So let's just do things in a viable way. And there were other services that did allow that, and we have to compete. Where so you can take positions where you see that this is not what public officials appreciate, and it requires you to take a long-term bet towards positive regulation. Similar thing with gig economy. Similar thing with your vehicle lifetimes, or where you procure them, and do you have the qualifications and so on and so forth, the licensing, the standards on the vehicles. But in the short term, we suffered again. Like, we didn't raise the largest amount, so we've been around for 6 years, and I'm just saying we raised 6 million. But the good news is we've been doubling our revenues outside of COVID year on year, and we just see the trajectory going that way, rather than trying to tenfold it year after year and then passing out. We hopefully will continue this more healthy, still exponential trajectory of growth.
Fair enough. Well, look, and I want to actually get into that as well, because I think that you kind of alluded to it in your discussion around fundraising, which is, so you started 2015. You've been around for 6 years. How much money have you raised, and then and obviously as well, I know that you've just gone public on the Nasdaq. The Nasdaq North, what's it called? North.
Nasdaq First North. Yes.
First North. There we go. I didn't even know what that was. So an explanation of what the Nasdaq First North is probably the first place to start, and then we can go into what does that actually, what the fundraising journey has been.
Sure. Yeah. So Nasdaq as a company as Nasdaq family has created Nasdaq First North, seeing a need for a small cap listing market in the Nordics. So there are Swedish, Danish, Norwegian companies in Nasdaq First North, and the market cap is anywhere between $10 and $100 million. Let's say, broadly speaking, that's about the market there.
Okay. And it's based in Copenhagen.
There are Swedish and Danish and Norwegian companies. They are serving all these 3 countries. So I'm not sure if they are only based in one city and not the other.
I mean, I guess in these days as well, you don't really have it based in. I was thinking that obviously Nasdaq's based in New York City, but it might not be so much like that anymore. Sorry, apologies. As you were.
We are traded in Danish kroner, and it's pegged to euro. It's been so for since euro was established at 7.5 Danish kroners to euro. So it's quite a stable currency, and it's a quite nice market. We have listed there in May of this year. We've raised just short of 15 million euros, 14.7 million euros. And I have a slide here about that, I think. So we raised 10 million of the of almost the 15 from institutional investors, including European Investment Bank and 2 pension funds. And then the remaining 5 million was raised from retail investors, which were pretty much all Danish.
Right.
And what we're doing with this is we expect to be cash positive in 23 and profitable in 24. And to get there, we'll be ramping up the SaaS revenue. SaaS is where, the whole thing with the partnerships, so software as a service. It's higher profit margin when we run SaaS compared to MaaS, just because we don't have the whole operation, and the software has almost zero margin. Zero cost, so a lot of margin. And then the MaaS B2B and B2G revenue, especially the B2G revenue, is tremendous, making a tremendous difference. The whole public finance coming in, also wonderfully recurring. And then we are growing the e-bike fleet, and we're seeing also really good synergies from having e-bikes next to pedal bikes. People who define themselves as cyclists switch regularly between those two, depending their distance and how tired they feel, and the wind and everything else, right?
Yes. Yep. Naturally.
That's also looking great. And we've we set the target, and I can see that is kind of dropped here, but we set the target at around 30 million euros by 2024 as the revenue target. So that would be around 40 million dollars by 2024.
Right. And so relatively speaking, I mean, so you're at $30 million. So that's, I'm just thinking of the fact that you've got, like, I'm trying to think of the krona dollar conversion here. Forgive me.
So we come from 5 million in 2019 to
yes, okay.
$5 million to $35 million in 2024.
Right. And I guess the question that I have in that, right, is going, well, that seems to me like a relatively decent growth business. It's not, crazy, Zoom in the beginning of a pandemic sort of crazy, but, nothing to be sneezed at. What's the reception been from, in general, from that kind of going public? Because you're one of the first companies that's gone public. Like, there's only, the only other company is obviously Bird's looking at going via a SPAC, but that's not been announced. Like, that's kind of been announced, but not yet. It's been sniffed around, but not yet actually confirmed. And the only other one that we have is Halbers, which is obviously going public in the US, and that still hasn't actually gone live yet. So at the time of recording, so you were in some ways like I feel like a canary in the coal mine of how the public markets might actually think about this.
Right. Obviously, we're not a scooter company. We're a bike sharing company, and most of our fleet, 90+%, is currently pedal bikes. Although it will change and it will be more like 1/3 or 1/2 will be e-bikes by 2024. But we are not exactly a scooter company, but we have a lot of interesting numbers to share about the micromobility market. And we have a quite different take. As you see, we're not growing as aggressively as some of the others. We deploy different kind of business model and very much working with the cities. So, but I think one of the key aspects of Donkey Republic, and you can see in 2019 here, we've been running positive unit economics. We've been running, our operations were covered by the revenue. And that's been the trend since we have actually launched. We've been having profitable cities and not so profitable cities, but overall we have not been scaling something that was losing money. And when I see actually Bird's numbers, I kind of get scared a little bit. And you can see in this chart that in established MaaS cities, which is where we had been present for 2 years or more, we've been having 14% contribution margin as of 2019, which was 2/3 of our fleet. And outside of COVID, we very much expect to have again positive contribution margins. And when I say positive contribution margins, that is revenue less cost of operating, less depreciation. So everything except for HQ costs was positive for us until 2019, and outside of COVID, we expect to be positive. And just to shine light on what you just said about Bird and Donkey Republic in comparison, I put this slide together where we compare the two companies, let's say, enterprise value to the revenues generated in 2020 and revenues expected in 2023. So I think that Donkey is currently priced quite low. Our enterprise value to revenue ratio of 2020 is 6x, whereas Bird's is 24x, and our enterprise value compared to revenue for 2023 is about 1x, whereas Bird's is about 3x. And we've had about 0 profit margin in 2019. They had -77% profit margin in 2019. So we have really much better unit economics and still and not aspiring to grow as fast, and still not receiving the kind of value. So I think we are the one thing I'll push back on there a little bit is that Bird hasn't actually gone public yet, so we don't really know what the market's going to value it at. I would argue that like you could look at the parallels of maybe like an Uber or a Lyft or something like this and say, look, they also didn't have particularly solid unit economics, though by the time they'd gone public,
They really kind of sorted a lot of that stuff out. They'd got pretty efficient in their operations and things like that. It is also a little bit tricky as well. I mean, I always look at Bird and think, by 2023, they want to be doing 815 million in rev. Like, where are they going to get those cities? Like, which cities do they have to win if they're going to be a shared operator to be able to like get that level of revenue? And I don't personally, I just struggle to see that a little bit sometimes. Right. Just because it feels like a lot of the larger cities have kind of largely tapped out, and the rollout is certainly not going to be that quick. The one thing I really like about your model is that, you can do the tier 3 and tier 2 cities, because it feels to me like, I assume you know of the Hello Bike model from China, but like, once Mobike and Ofo had kind of self-combusted, right, it was Hello Bike who won, and Hello Bike's kind of the one who now operates everywhere. Right. But they had started out in tier 3 cities,
Yeah, they picked their battles right. I mean, that's been also, we did launch first in tier 1 cities back in 2017. Again, before the Ofo and Mobike and the scooter companies kind of came around, we were first to go there, and kind of the cities were saying, oh yeah, cool, you're welcome. And then 1 year after, we had to renegotiate a whole permit thing. But yeah, I think the partnership model that we found, and the whole thing around being able to operate a small fleet, as small as, well, if you look at, we have 2,700 bikes, 60 locations, say 3,000 bikes. So we're talking about 50 bikes per location. Mm-hmm. So many of them are really smaller locations. Yet the system works even for smaller locations. So partners are happy, and we can launch them profitably from our side, very profitably. And also our partners are quite happy, because many cities are offering or campuses are offering a really great deal. And then we also see a fantastic growth rate year on year in these locations as well. So people are, when customers are happy, many of the deals that we've won and grown, as you can see here, as part of the growth of a large part of the 70 deals, of which we won 40, a significant part is now from growth deals that some city has bought previously. Mm-hmm. Mm-hmm. I want to maybe draw attention to one more thing, if you like.
Yeah, go for it. Yeah, shoot.
Which is diversity of revenues. So during COVID, or before COVID, we were earning more than half of our revenues from visitor market. So B2C and visitors. So the first bracket here, the rider revenues, we were earning quite a large amount of that from visitors.
When you say visitors, sorry, what do you mean by visitors?
Visitors are people visiting another town, or actually tourists, let's say, from another country.
Yes. Okay. Oh, you mean on those sort of pay as you go rather than being on membership? Yeah, or being on a public transport system or something like that. Yeah. Right. Okay. Catch you.
And that represented more than half of companies' total revenue. And with COVID, that came to a total standstill. But we did very well in scaling the SaaS partners. We did very well in getting public funding for our own operations. Also selling to corporates as memberships, so all of your employees become members at once, and also memberships for riders. And there we are looking into getting riders to kind of test with the concept of leasing a bike that is also a bike share. So you can keep a donkey bike for a long period with yourself before you swap it when you want to.
Right. That makes a lot of sense. I can see that being a thing. Excellent. Hey, well, look, I'm conscious of time, and we're going to wrap up this section of the podcast, and then we'll go into questions for folks who do want to learn about this. Micromobility membership is the name of the game. Come and join us, and then you can come and sit in on webinars such as this. But in the meantime, Erdem, for folks who want to learn or make contact with you, like what can be useful for you, and how can you be useful to others in terms of being able to offer something from Donkey?
Sure. I think for anyone who wants to operate a proven and easy, turnkey, convenient bike or e-bike solution, we're not just selling hardware. We have our own designed hardware, the whole back end and front end well integrated. It's like an Apple product. It works just off shelf. You are welcome to contact us, whether you want to work in a campus or real estate or a small town or as part of a utility operation, that would be the most, I think, interesting thing to follow. And if you have donkeys in your city and you're listening in from a corporate, if you'd like to get a membership, please contact us. We have very happy corporate clients. And if you're an investor and you are interested in the transport micromobility industry, we think we have a really good bargain for you. If you're North American, you can contact most large banks have some kind of trading relation with Nasdaq. Otherwise, outside of US, you can just enter the Saxo platform, which is a trading platform to buy donkey shares. So those are the 3 points, I guess.
Awesome. Excellent. Well, thank you so much for your time. And it's marvelous to have you on and to understand this. I as I said, I really appreciated the chutzpah of turning up at the Berlin Micromobility Conference and parking up bikes outside and locking them to a bunch of things so everybody saw them as they walked in. It was very smart marketing. So I was always like, oh, I want to talk to this guy. So yeah, hey, pleasure to have you on. And thank you very much. I hope to have you on soon.
Pleasure to speak to you, Oliver. Thanks for having me again. Bye-bye.
Cheers.